Today's topic might sound a little strange. Can you actually make money from market crashes? Buckle up, because we're diving deep into the SVOL ETF, a fund designed to profit from low volatility, which kind of goes against everything Wall Street tells you, right? But is the SVOL ETF a volatility-crushing superhero or a ticking time bomb? We'll break it all down in the next few minutes, including how it works, the fees involved, and some alternative strategies. Stay tuned. What is SVOL ETF? The SVOL ETF, which stands for Simplify Volatility Premium ETF, is an exchange-traded fund designed to provide exposure to the volatility of the stock market while also aiming to generate income. Here's a breakdown of what SVOL does and how it works. Investment objective. SVOL seeks to deliver returns inversely proportional to the CBOE Volatility Index, VIX, short-term futures index. In simpler terms, it aims to profit when market volatility is low and potentially lose money when volatility spikes. The target return is positioned within a range of -0.2x to -0.3x, the inverse of the VIX index. This means SVOL aims to generate returns that are roughly 1/5 to 3/10 times the opposite movement of the VIX. For example, if the VIX rises by 10%, SVOL would ideally target a return between 2% and 3%. Strategy. Unlike some ETFs that directly track an index, SVOL utilizes a more complex strategy to achieve its volatility target. Since the VIX itself is an index, not a tradable security, SVOL can't directly short sell it. To achieve its objective, SVOL employs a strategy involving options overlays. This means the fund uses a combination of buying and selling options contracts to capture the volatility premium inherent in the VIX futures market. Key points to consider. Income generation. One of the attractive features of SVOL is its potential for generating income. The options overlay strategy used by the fund can result in regular distributions. However, it's important to remember that these distributions may not be guaranteed and could fluctuate depending on market conditions. Risk profile. While SVOL aims to profit from low volatility, it comes with its own set of risks. The options overlay strategy can be complex and may not perfectly track the inverse of the VIX. Additionally, periods of high market volatility could lead to losses for the fund. Management fees. Like any ETF, SVOL has associated management fees and expense ratios that eat into returns. It's crucial to factor in these costs when evaluating the overall performance of the fund. Who is SVOL ETF a good fit for? SVOL might be suitable for investors seeking volatility hedging, those looking to hedge their portfolios against potential market downturns. By profiting from low volatility, SVOL can help offset losses in other holdings during volatile periods. Income generation. Investors interested in a potentially steady stream of income from the ETF's distributions. Diversification. SVOL can add a unique element of volatility exposure to a diversified portfolio, potentially enhancing overall risk-adjusted returns. How does the SVOL ETF achieve its volatility target? The SVOL ETF, Simplify Volatility Premium ETF, achieves its volatility target through a strategy known as options overlays. This strategy involves the use of call options and put options on VIX futures contracts. Here's a breakdown of how it works. Understanding the VIX. The SVOL ETF doesn't directly invest in stocks or bonds. Instead, it focuses on the CBOE Volatility Index, VIX. The VIX is a benchmark that reflects market expectations of short-term volatility in the SP 500. It's crucial to remember that the VIX itself isn't a security you can buy or sell directly. Options overlays explained. Since the VIX isn't directly tradable, SVOL utilizes options contracts on VIX futures contracts. These futures contracts speculate on the future value of the VIX index. The core of SVOL's strategy lies in strategically buying and selling call and put options on these VIX futures contracts. Let's delve deeper into the option types used. Call options. When SVOL buys call options, it essentially gains the right, but not the obligation, to purchase VIX futures contracts at a predetermined price, strike price, by a specific expiry date. Put options. Conversely, when SVOL buys put options, it acquires the right, but not the obligation, to sell VIX futures contracts at a predetermined price, strike price, by a specific expiry date. Capturing the volatility premium. By employing these options strategically, SVOL aims to capture the volatility premium embedded within the VIX futures market. This premium represents the difference between the current price of a VIX futures contract and its expected future value based on historical volatility patterns. Here's how the options overlays can achieve the target return. Low volatility scenario. If market volatility remains low, the VIX and VIX futures prices are likely to stay subdued. In this scenario, SVOL can potentially benefit from letting purchased call options expire worthless. Since the VIX futures price hasn't risen above the strike price, exercising the call options wouldn't be profitable. However, SVOL keeps the premium paid for the call options. Selling previously purchased put options at a profit. As the VIX and VIX futures prices stay low, the demand for put options, which give the right to sell, decreases. SVOL can potentially sell these put options for a profit compared to the initial purchase price. High volatility scenario. If market volatility spikes, the VIX and VIX futures prices are likely to rise. In this scenario, SVOL might face challenges. Exercising purchased call options at a loss if the VIX futures price increases beyond the strike price. However, this might be offset by gains from selling put options. Put options expiring worthless if the VIX futures price doesn't fall below the strike price. What are the primary risks associated with investing in the SVOL ETF? The SVOL ETF, Simplify Volatility Premium ETF, offers a unique strategy, but it comes with inherent risks. Here's a breakdown of the primary risks you should consider before investing. 1. Tracking error. Imperfect inverse relationship. While SVOL aims for an inverse return to the VIX volatility index, its options overlay strategy might not perfectly achieve this target. This deviation from the targeted return is known as tracking error. Market movements. The effectiveness of the options overlay strategy relies on anticipating future market volatility. Unexpected changes in volatility can lead to tracking errors and potentially lower returns for SVOL investors. 2. Options risks. Complexity of options. Options are complex financial instruments with unique risks. SVOL strategy relies heavily on options, and any miscalculation or unforeseen market event can result in significant losses. Time decay. Most options lose value over time decay, regardless of the underlying asset's price movement. This time decay can erode the value of SVOL's holdings, especially if the options expire before the targeted return is achieved. 3. Market volatility. High volatility events. While SVOL aims to profit from low volatility, periods of high market volatility can pose significant risks. The options positions might not perform as expected, leading to losses for the fund. Sudden market swings. Sharp and unexpected market movements can disrupt the options overlay strategy, potentially causing significant losses for SVOL investors. 4. Counterparty risk. Options counterparties. When SVOL enters into options contracts, it relies on counterparty institutions to fulfill their obligations. If a counterparty defaults, SVOL could suffer financial losses. Creditworthiness of issuers. The options contracts used by SVOL rely on the creditworthiness of the issuers, typically large financial institutions. If an issuer becomes insolvent, SVOL might face difficulties recovering its investment. 5. Management risk. Skill and experience of fund managers. The success of SVOL hinges on the skills and experience of the fund managers responsible for implementing the options overlay strategy. Any missteps in managing the options positions could lead to losses for investors. Complexity of strategy. The options overlay strategy itself is intricate and requires ongoing monitoring and adjustments. Any errors in managing this complexity could negatively impact SVOL's performance. How does the SVOL ETF manage downside risk? The SVOL ETF, Simplify Volatility Premium ETF, aims to manage downside risk through its options overlay strategy, but it's important to understand that this approach has limitations. Here's a breakdown of how SVOL attempts to mitigate downside risk and the inherent limitations. Strategies to mitigate downside risk. Targeting low volatility. The core concept of SVOL revolves around profiting from periods of low volatility. By capturing the volatility premium through options, the fund aims to deliver positive returns when market swings are subdued. This can potentially offset losses in other parts of your portfolio during such periods. Selling cash-secured puts. SVOL might utilize a strategy called selling cash-secured puts. This involves selling put options on the underlying assets, potentially VIX futures, while holding enough cash to cover the potential obligation to buy the asset if the put option is exercised. This strategy can generate income from the premium received for selling the put options, while also limiting the downside risk by having the cash readily available. Protective call options. In some instances, SVOL might employ protective call options on its holdings. By purchasing call options, the fund establishes an upside limit for potential losses. This can be particularly useful during periods of unexpected market rallies that could otherwise erode the value of the options overlay. Limitations of downside risk management. Imperfect hedging. The options overlay strategy, while attempting to hedge against downside risk, is not a perfect safeguard. Unforeseen market events or miscalculations in option selection can still lead to losses for SVOL. High volatility events. During periods of extreme market volatility, the options overlay strategy might not perform as expected. The complex interplay between options and market movements can lead to significant losses if volatility spikes beyond anticipated levels. Time decay. As mentioned earlier, options lose value over time decay, irrespective of the underlying asset's price movement. This time decay can erode the effectiveness of the options overlay as a downside risk hedge, especially if the targeted return is not achieved before options expire. How liquid is the SVOL ETF? The liquidity of the SVOL ETF, Simplify Volatility Premium ETF, is an important factor to consider before investing. Here's a breakdown of what liquidity means for ETFs and how it applies to SVOL. Liquidity explained. Liquidity refers to the ease with which an asset can be bought or sold at a fair price in a timely manner. In the context of ETFs, liquidity is measured by factors like trading volume. This represents the number of shares traded daily. A higher trading volume indicates a more liquid ETF, where investors can easily enter and exit positions. Bid-ask spread. This is the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share of the ETF. A narrower bid-ask spread signifies better liquidity, as investors can buy or sell closer to the ETF's fair market value. SVOL's liquidity. Emerging ETF, launched in 2020, SVOL is a relatively new ETF compared to some established volatility-focused options. This can impact its liquidity. Trading volume. While SVOL's trading volume has been increasing, it may not be as high as some other, more widely traded ETFs. This could potentially lead to wider bid-ask spreads and make it slightly more challenging to buy or sell shares at the desired price, especially during periods of lower market activity. Potential impacts of lower liquidity. Higher transaction costs. Wider bid-ask spreads can translate to higher transaction costs for investors when buying or selling SVOL shares. The difference between the buying and selling price eats into your overall returns. Execution delays. In less liquid markets, it might take longer to execute trades, meaning you may not be able to buy or sell shares at your preferred price immediately. How concentrated are the holdings within the SVOL ETF? The SVOL ETF, Simplified Volatility Premium ETF, exhibits a relatively high concentration of holdings compared to some traditional ETFs. Here's a breakdown of why concentration matters and how it applies to SVOL. Concentration explained. Number of holdings. Concentration refers to the number of underlying assets held by an ETF. A highly concentrated ETF holds a smaller number of assets compared to a broadly diversified one. Concentration and risk. Higher concentration, higher risk. A higher concentration of holdings can amplify both the potential rewards and risks associated with an ETF. If a few holdings perform poorly, it can significantly impact the overall performance of the ETF. Limited diversification. Highly concentrated ETFs offer less diversification compared to broadly diversified ones. Diversification helps mitigate risk by spreading investments across different asset classes and companies. SVOL's concentration. Limited number of holdings. While information can vary slightly depending on the data source, SVOL typically holds between 10 to 15 assets. This is a relatively low number compared to many stock or bond ETFs that might hold hundreds or even thousands of underlying assets. Focus on options contracts. It's important to remember that SVOL's holdings are options contracts on VIX futures contracts, not directly stocks or bonds. Why concentration might be higher for SVOL. Complexity of strategy. The options overlay strategy employed by SVOL is intricate and requires the use of specific options contracts to achieve the targeted volatility exposure. This can limit the number of holdings compared to a more passive investment strategy. Focus on capturing volatility premium. SVOL doesn't aim to replicate a broad market index, but rather to capture the volatility premium through specific options. This targeted approach might necessitate a more concentrated holding base. How frequently does the underlying composition of the SVOL ETF change? The underlying composition of the SVOL ETF, Simplified Volatility Premium ETF, can change frequently due to the dynamic nature of its options overlay strategy. Here's a breakdown of why the composition changes and what factors influence the frequency of these changes. Options and dynamic adjustments. Unlike traditional ETFs that hold stocks or bonds for extended periods, SVOL's holdings consist of options contracts on VIX futures contracts. Options contracts have expiration dates, meaning they hold value only for a specific time. Active management. To achieve its target volatility exposure, SVOL relies on active management by the fund managers. They continuously monitor market conditions and adjust the options overlay strategy by buying and selling new options contracts as needed. Factors influencing change frequency. Market volatility. The frequency of changes in SVOL's composition is likely to be higher during periods of significant market volatility. The fund managers might need to adjust the options overlay more frequently to adapt to changing volatility expectations. Options expiration. As options contracts approach their expiration dates, SVOL will need to buy new options contracts to maintain its desired volatility exposure. This inherently leads to changes in the fund's composition. Strategy adjustments. The fund managers might also adjust the options overlay strategy based on their evolving outlook for future market volatility. This could involve changing the types of options contracts used, the strike prices, or the maturities. Transparency and finding information. Limited disclosure. Due to the complexity of the options overlay strategy, SVOL might not publicly disclose the daily details of its holdings, specific options contracts. Focus on performance. Investors should primarily focus on SVOL's overall performance and its ability to achieve its target inverse return to the VIX. Alternatives with less frequent changes. If you prefer ETFs with a more stable underlying composition, here are some alternatives. Broad market ETFs. These ETFs typically track a specific index and rebalance their holdings periodically, quarterly or annually, to reflect changes in the index. Index funds. These passively managed funds aim to replicate the performance of a specific index by holding the same underlying assets in similar proportions. Their composition changes only when the underlying index itself changes. What are some alternative investment strategies to achieve similar volatility targets? If you're looking to achieve similar volatility targets to the SVOL ETF, Simplify Volatility Premium ETF, here are some alternative investment strategies to consider. Each approach has its own advantages and disadvantages, so it's crucial to evaluate them based on your risk tolerance and investment goals. 1. Inverse Volatility ETFs. Concept. These ETFs directly aim to deliver returns that are inversely correlated to market volatility. They might achieve this through various methods, such as using inverse futures contracts on volatility indexes, like the VIX. Similar to SVOL, like SVOL, these ETFs profit from periods of low volatility. However, their structure might differ, potentially leading to variations in performance and fees. Considerations. Carefully research the specific underlying instruments used by the inverse volatility ETF. Some might be more complex or less liquid than SVOL. 2. Managed futures funds. Concept. These actively managed funds invest in a variety of futures contracts, including stock indexes, commodities, currencies, and interest rates. The fund manager uses their expertise to navigate these markets and potentially profit from short-term trends and volatility. Volatility targeting. While not solely focused on volatility, some managed futures funds can achieve returns with a lower correlation to traditional stock and bond markets. This can offer a hedge against market downturns. Considerations. Managed futures funds involve active management fees and can be complex. Choose a reputable fund with a proven track record and a clear understanding of their risk profile. 3. Options-based strategies, DIY. Concept. For experienced investors, building your own options-based strategy can offer more control over your volatility exposure. This might involve selling cash-secured puts or using collar options on underlying assets. Tailored approach. You can customize your options strategy to your specific risk tolerance and desired level of volatility exposure. High complexity and risk. Options trading requires a deep understanding of options mechanics, risk management, and market dynamics. Mistakes can lead to significant losses. This approach is generally not recommended for beginners. 4. Diversification with low volatility assets. Concept. Building a diversified portfolio that includes asset classes with historically lower volatility, such as certain high-quality bonds, utilities, or consumer staple stocks, can offer some protection against market downturns. Reduced overall volatility. By incorporating low volatility assets, you can potentially achieve a smoother overall portfolio ride, even if the returns might be slightly lower compared to a purely stock-focused portfolio. Limited upside potential. Low volatility assets may underperform during periods of strong market rallies. How do the expense ratios and fees of the SVOL ETF compare to alternative strategies? Here's a breakdown of how the expense ratios and fees of the SVOL ETF, Simplify Volatility Premium ETF, compare to the alternative investment strategies we discussed previously. SVOL ETF. Expense ratio. The SVOL ETF typically has a published expense ratio that covers the ongoing operational costs of running the fund, including management fees. This expense ratio is an annual fee deducted from the fund's net asset value, NAV, which reduces overall returns for investors. Alternative strategies. 1. Inverse volatility ETFs. Expense ratios. Similar to SVOL, inverse volatility ETFs also have expense ratios that cover their operational costs. These expense ratios can vary depending on the specific ETF and its underlying strategy. Potential additional fees. Some inverse volatility ETFs might have additional fees, such as performance fees based on the fund's outperformance of a benchmark. 2. Managed futures funds. Management fees. Managed futures funds typically charge higher management fees compared to ETFs. These fees can range from 1% to 3% or more of the fund's assets under management, AUM, annually. Performance fees. Many managed futures funds also charge performance fees on top of the management fee. These fees are typically a percentage of the fund's profits. 3. Options-based strategies, DIY. Commissions. When you trade options yourself, you'll incur commissions for each trade you place. These commissions can eat into your returns, especially for frequent trading. Data fees. Depending on your broker and the level of options data you require, there might be additional data fees associated with options trading. 4. Diversification with low volatility assets. Underlying ETF fees. If you use ETFs to achieve diversification with low volatility assets, you'll be subject to the expense ratios of those specific ETFs. These expense ratios can vary depending on the underlying asset class and the chosen ETF. Are there any actively managed funds that target similar volatility characteristics? Yes, there are a few actively managed funds that target similar volatility characteristics to the SVOL ETF, Simplify Volatility Premium ETF. However, it's important to understand that these funds might achieve their goals through different methods compared to SVOL's options overlay strategy. Here's a breakdown of what to consider. Types of actively managed funds targeting volatility. Alternative risk premia, ARP, funds. These funds aim to capture returns from alternative asset classes and strategies, with a focus on managing volatility and potentially providing a hedge against traditional market downturns. They might utilize a variety of instruments like managed futures, options, and alternative credit. Low volatility equity funds. These funds actively select stocks with historically lower volatility characteristics, aiming to deliver smoother returns with less exposure to market swings. They might focus on sectors like utilities, consumer staples, or healthcare. Volatility targeting funds. These funds are less common but might employ a more targeted approach to volatility exposure. They might utilize derivatives or other strategies to achieve a specific level of volatility relative to the broader market. Similarities and differences to SVOL. Volatility focus. Like SVOL, these actively managed funds share a focus on managing volatility and potentially profiting from periods of low volatility. Implementation differences. Unlike SVOL's options overlay strategy, these funds might achieve their volatility targets through various methods depending on their specific investment approach. The SVOL ETF offers a unique way to play the volatility game, but it's not without its complexities. Focuses on profiting from low volatility, not direct investments in stocks or bonds. Utilizes options on VIX futures contracts, leading to a concentrated and frequently changing holding structure. Carries expense ratios and potential tax implications through dividends and capital gains distributions. We also explored some alternative strategies to achieve similar volatility targets, like inverse volatility ETFs, managed futures funds, options-based DIY approaches, and diversification with low volatility assets. Remember, the best approach depends on your risk tolerance, investment goals, and experience. Do your research, consider consulting a financial advisor, and never invest in something you don't understand. Thanks for joining us on Chat ETF today. Leave a comment below with your thoughts on the SVOL ETF, and let us know what other interesting ETFs you'd like us to dive into next. Hit that like button and subscribe for more in-depth ETF discussions.